Hey, Jason here. Today's video, we're going to continue answering the question, is Baidu a great stock to buy? This is part 2 of our analysis on Baidu. In part 1, we found out that their initial numbers look pretty good, actually really good. So we are going to continue analyzing them, and I'm going to pump this up here because it looks a little small on the screen. So there we go on the other screen. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Value Investing podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Okay, brief disclaimer here today. Got the full disclaimer in part 1. I don't short sell ever, blah, 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 blah. Again, I don't want to do this. I have to do this because every time I don't, I get nasty comments. This is for your informational purposes only. I also don't own any stock in Baidu either, but this is for your informational purposes only to help you learn how to better and faster evaluate stocks so you can spend less time evaluating terrible stocks and more time evaluating potentially great stocks. Doing this will increase your odds drastically, finding and beating the market if you want to beat the market as an investor. Okay, let's get my face out of here. Okay, increase the size of this screen as well. Okay, so hopefully that is good. Both screens good. Okay, so this is gonna weird me out a little bit. There we go, let's make that a little bit smaller. Because on my screen they are gigantic. So we're going to do here, again, this is the preliminary analysis template. If you haven't seen our other videos using this template, you can get this for free at the link below in the 5 free gifts. All students get this as well if you join the Masterclass. But this, I've only updated this. Baidu is obviously not an $18.8 million market cap company. This is from another company we analyzed. I believe this was for Masterclass students. We analyzed this stock, this tiny company. So what we're going to do here is we're going to go through the worksheet, and I'm going to tell you what I see, why I see it, why it's important, why it's catching my eye, all that kind of stuff, so you, again, can better and faster evaluate stocks. Okay, they are a $57.2 billion market cap company. And they are in, I'm assuming, the US dollars. Yeah, dollar sign up here. Usually it says down here, actually it says right here, US dollars. You want to make sure, especially foreign companies or non-US based companies, what currency you're in, because it could have, and usually will have, a gigantic difference on the valuation. But it looks like this one is in US dollars, so we are good there. We'll pay a dividend. And see what I mean over here. So these numbers are in CNY millions. This is Chinese yuan, or also known as, I think, renminbi. I think that's how you say it. So we're going to have to convert some numbers at some point, but for now, we're going to keep going along with this. So the trailing 12-month operating profit margin is 14.7%. And their 5-year average is, let me calculate it here. And again, if you haven't seen my other videos, we do not use this when calculating the 5-year average operating margin, the trailing 12-month numbers. We use 5 years prior, 5 full years prior. Plus 18.5, plus 15.2, plus 5.9, plus 13.4. Okay, so 13.4. rounded up, is their 5-year average operating margin. I look for anything above 10% here consistently. So this surpasses my threshold. Something I did notice here is that their operating margin, again, I believe I pointed this out in the original video, which you can see in links below for free. In the original video, their operating margins have cratered as they've continued growing, which means they're not keeping their costs under control. But frankly, and I think I remember saying this, companies, pretty much no companies have 52.2% operating margins. except for maybe SaaS companies and other companies similar like that. So they were pretty much destined to come down as they grew anyways. Okay, share count. Gone down a little bit. 50 million since 2011 to 348 million in the trailing 12-month period. And that is not even 1%. It's 1% rounded up. Percent in the last decade. Again, not a huge deal here, so we're not going to spend a ton of time talking about this like we usually do. Okay, these numbers in US dollars. We will not have to convert these. From 5.06 per share in 2011 to 102.73. That is a massive rise. Minus 5.06 divided by 5.06 of 1930% in the last decade. That is fantastic. This is a great sign that the underlying intrinsic value of the company is going up over time. We will see, because I do not remember if this was due to acquisitions and goodwill. I'm assuming some of it is. But we will see that is, in general, a great sign that the company's underlying intrinsic value is going up. In this case, significantly, 19x in the last decade. ROIC 15.1. And again, last 5 full years numbers here, not the trailing 12-month number. Minus okay, 8.04, but 8 rounded up. So what I see here is their trailing 12-month ROIC is almost double their 5-year average. So I want to know what happened in the last 5 years. Why, and this year, why are their ROICs so much higher? Should we expect them to stay in the 15% range? Should we expect them to be somewhere in the 8% range? Should we expect them somewhere in the middle, above, in between, or below? The reason we need to know this is not only because ROIC shows how much profitability you produce as a company, and it's one of the most important numbers for that reason, but we also want to know what we should expect going forward in terms of ROICs, because a company with a 15% ROIC surpasses my threshold and should be valued higher than something that earns 8% ROICs, which does not pass my threshold. I look for anything above 10% consistently on this number. And something at 8% ROIC will be valued lower. So this will affect, again, essentially the entire analysis, whether it's 8%, and we should expect that going forward, 15%, something different than those numbers, and it'll affect the valuation as well. Are we 2.3? Again, 5-year average number here, 13. Huge increase this year again for the ROE, but the only reason I care about the ROE here is to compare it to the ROIC, the trailing 12-month ROIC, because if the company has debt, or if the company has a higher ROE than ROIC, it means the company has debt. So this means the company has a decent amount of debt. We'll get to that more in a little bit, possibly. Now, free cash flow to sales is fantastic. Say 13.2%. I look for anything on this number for 5%. Higher than 5% consistently, 17.6, and again 5 last year, full years. And this far surpasses my threshold. So this is interesting though. So usually on the other two metrics, we've seen higher trailing 12-month numbers than 5-year average. This is reversed here. We're seeing lower trailing 12-month free cash flow compared to 5-year average free cash flow. I want to know why, because that doesn't line up with what we saw above. Really anything we saw above, because their revenues are going up, their profits are going up, except for this number. So I would want to know what's happening here with the free cash flow. Are they spending it more? Are they spending more free cash flow? Are they investing? Are they selling less shares? Are they selling, which they're buying back shares, so this could be part of it. Are they issuing less debt? What are they doing now that's different? Are their costs rising this year? Which could be, frankly, the case because of the supply chain issues worldwide. I want to know, because this does not line up with everything else we've seen above. Okay, and they do not have a cash conversion cycle, which is a little bit surprising. Actually not surprising now I think about it, because they're more of a platform that they don't actually, they help facilitate the buying and selling of goods and bulk goods and stuff worldwide. They don't necessarily own the stuff, so that does make sense, thinking about it logically, why they don't have a cash conversion cycle. Okay, so let's see, and all the formatting got jacked up here, so I apologize for that. Not sure what happened here, but that's going to annoy me. So I'm going to move this. Oops. Oops. Okay. So, enterprise value. Need to calculate this. Enterprise value, again, if you haven't seen other videos like this, is far better than just looking at the market cap, because enterprise value includes both cash and debt. And since 99% of all companies on earth have both of those things, as a total business owner, which is how I look at a stock, before I own anything, I consider myself a owner of the stock, because technically I own my share of whatever the company is. And so I want to know what the total price of the company is. Enterprise value is far better than, or these numbers, enterprise value to EBIT, enterprise value to free cash flow, are far better than PE for those reasons. And in terms of the E part, I also don't like earnings or net income, which I've talked about in several videos. You can find here on the YouTube. I much prefer operating profit, or EBIT, and free cash flow. Okay, so the market cap is 57.2. Now, let's go to their cash, or their balance sheet. These numbers in CNY, and are we going to have to convert them? They are in CNY, so we're going to have to convert them. Okay, so CNY to USD. And they have $169.28 billion CNY, or billion CNY, in cash equivalents, short-term investments. 169.28. And that is 26.46. Again, this is why conversions are so important, because this number here, if we didn't convert it and we didn't know if this was in US dollars or a CNY, Chinese yuan, we would get 57.2 US dollars minus 169.28 Chinese yuan, and that would be a massively wrong number here, and would give you a massively wrong numbers up here. So this is why you have to make sure you're in the correct currency when you're doing this kind of stuff. Short-term investments. Long-term investments. Are they calculated somewhere else? Okay, long-term investments. Oop, I'm looking at the wrong thing. We're looking for short-term debt now. I was looking at the wrong thing. Sorry about that. So current portion of long-term debt, or current debt and capital lease obligation, 11.21. Long-term debt. $77.99. And I'm assuming they have no preferred stock. We will check still. I don't see any preferred stock. Minority interest. Oops, wrong page. Okay. I don't see any preferred stock or minority interest, but again, I will go up and check just to make sure. And I'm not seeing any preferred stock. Not seeing any minority interest, although I don't know what this total long-term investment is without looking at their financials, so for now we'll just leave it out. And I do not see any minority interest either. So plus 0 plus 0. So 57.2 minus 0.46 plus 11.21 plus 77.99 equals billion USD. Oops, and I did not. Again, I just missed it there. I did not turn these in from CNY to USD. Just caught that. So 11.21. So 1.75. Again, that would be make a massive difference there. 77.99. Because I was just thinking, I saw what the calculation was going to be. I was like, that doesn't make any sense. 1.9. Okay, so now we have the correct calculation here. Plus 1.75 plus 12.19. Okay, so this is why this makes such a big difference. As this went from 119.94 billion USD to 44.68. So, oops, not sure what's happening here. This being less than the enterprise, or this enterprise value being less at 44.68 billion than the market cap at 57.2 billion is one sign the company is undervalued. Why? Because that also means the company has more cash than it has debt, and that adds more margin of safety to the investment. Those are both very good things. That's what we look for generally, is those two things. So bring this up here. Go back. And these are in CNY again, so we have to convert them again. 17.17385. So this is 2.72 rounded up. Well, again, we're using billions here. I forgot the changes. Billions here, so we don't get things mixed up. 57.2 billion divided by 2.72 million, again, would be massively different number than 2.72 billion. So this way you gotta be careful when you're evaluating non-US stocks or non-stocks based on whatever country you're based in. Free cash flow, 15,599. And this is 2.44 rounded up. Okay, so I can tell right now this is going to be massively overvalued. $21 rounded up. And $23.4 rounded up. Okay. Why do I say these are going to show that the company's massively overvalued? Because I look for anything below 8 here. This is at 21 for the EV to EBIT. and even if your cash flow is 23.4. So these show the company is massively overvalued. What is the current number? This is what got me intrigued. On the other screen here on Morningstar's, their enterprise value was 5.67. I don't know what goes in. Oh, and I'm using the wrong number, which is part of the reason why I'm struggling today. I apologize for this. Should be using 44.68 and 44.68 here in the enterprise value part of the calculation, not the market cap. I kept using the market cap, but it's not going to make that huge of a difference. 44.68 divided by 2.72, 16.4. Oops. And 18.3. So still massively overvalued, but there's a massive difference here between the enterprise value on Morningstar and the enterprise value I calculate. Why? I have no idea. I'm not sure. I don't know what goes into Morningstar's numbers, but this is why I always calculate my numbers as well. Down here, for example, ROIC is another one of my favorite numbers. If we got to the stage down here where it looked like we needed to calculate it, I don't rely on just Morningstar's numbers. I do the calculation myself as well for that. So these show now that Baidu is massively overvalued instead of massively undervalued, which is what Morningstar shows. And again, when in doubt, I always use my numbers because I know what goes into them. I don't know what goes into Morningstar's numbers. So the reason this shows the company is overvalued is the inverse of these, the 2.72 divided by 44.68, because this earnings yield shows you what you should expect to earn owning Baidu stock if you were to buy today based on today's information. 5.5%. I look for anything above 10% here and typically higher than that on the earnings yield. The reason I said this is what you should expect to earn is because, frankly, you will never earn whatever it is the amount shows. This is just kind of a guideline. However, with interest rates, something to consider that, frankly, hasn't been in consideration since the 70s and 80s in the U.S., is with inflation at super high rates right now, what this really means in a real world sense, 5.4% is the last inflation rate I saw in the U.S., so what this means is the real world expectation of this, if you were to buy today based on the free cash flow to enterprise value earnings yield, would be you're going to earn 1/10%. So how do I get to that? 5.5 minus 5.4% rate of inflation equals 0.1%. Now, this would actually even go negative when you consider taxes and fees and stuff like that. So a rate of return is not good right now for Baidu. Actually negative in a real world sense after, again, fees and taxes. This is why valuation is so important, because not only when things are overvalued, it makes them more risky. This is why it makes them more risky, because you're earning, or you should expect to earn, far lower investment returns as well. So at this point, again, I was super excited about Baidu because of what I saw on Morningstar, but again, I always trust my numbers more because I know exactly what goes into them. At this point, Baidu is no longer going to be a case study candidate for us because they're enormously overvalued. All their other numbers, for the most part, look great. They are enormously overvalued, though, right now, according to my calculation. Having said that, I would still add them to my watch list because, again, I think they're going to be around forever, or at least until China keeps cracking down on them. And they're going to keep doing what they do, essentially, and dominating over there. But because they're so overvalued right now, I cannot buy them in the portfolios I manage. So this will be the end of the Baidu case study. Again, this is why you always have to calculate your own numbers as well, because again, I don't know what goes into Morningstar numbers, and there's a massive difference from what 16.4, which is what my calculation was, to 5.7. That goes from massively overvalued to massively undervalued. There's a massive difference here, and again, I don't know why, because I don't know what goes into Morningstar's numbers. But this illustrates why you need to calculate your own stuff. So I hope this was helpful. I'm not sure what's happening with the camera here, with the focus. There we go. Hope this was helpful. If I missed something, if I didn't explain something well enough, if I should explain something better, let me know in the comments below. If you're watching on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. And if you do subscribe, make sure you also hit the notification bell so you're notified every time I release a new video, and release new videos all the time. If you subscribe and you hit the notification bell, you'll also be notified when we go live, and we're going to do that more often again here relatively soon, if we can get our schedule situated. If you're listening on the podcast, again, thanks so much. Really appreciate all that same stuff. On the podcast, though, we do also really appreciate a review, because the more reviews we get, the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, make sure to check out our 5 free resources, or our free resources below, including our 5 free gifts, where you can get the entire preliminary analysis template worksheet that we just did. You can get that so you can evaluate stocks better and faster yourself as part of the 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks. It's 3 times you must sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our Value Investing Masterclass, which you can also find the links below. Mastermind, or you can go to mastermind.valueinvestingjourney.com. Mastermind.valueinvestingjourney.com. In this program, you'll get an entire masterclass teaching you everything you need to know about how to find, value, and evaluate stocks fast, including 23 different valuation techniques, where to find these stocks, where exactly I find these stocks, how to read financial statements, all that. Plus, you also get live group trainings, which is just did another one yesterday. You get free access to those. You get free access to the groups, the WhatsApp group, the Facebook group, where we interact with each other, share analysis, answer questions, do all that stuff as well. You get all that and much more for joining the Value Investing Masterclass. Plus, right now, there's still $9,000 in free bonuses available. And these are legitimate bonuses that will be going away as soon as 10 people sign up for the Masterclass. You can get those for free, those $9,000 in bonuses for free by signing up to our Masterclass with a free trial, which comes with a free trial. We don't get paid anything until you are happy with the program. You don't get paid anything for 14 days. So you can try the program for free as well. And you can do that, again, at the link below, or go to mastermind.valueinvestingjourney.com, mastermind.valueinvestingjourney.com. Thanks. Thanks for watching. Hope you had a great day. Talk soon. Bye.